So, if you look at a medical x-ray, the diagnosis is usually, well, it's pretty absolute, right? Like, you have a broken arm, there's this jagged white line on the film, and the doctor just points to it.
Yeah, broken or not broken. Very binary.
Exactly. It's clean, it's undeniable. But then, you open up a stock chart for a company like, say, Tesla or Apple or Nvidia, and suddenly it's like that x-ray machine is just completely broken.
Oh, completely.
I mean, you can have two brilliant Ivy League educated financial analysts looking at the exact same balance sheet, the exact same cash flows, the exact same market conditions, and one of them will pound the table and say, this stock is the bargain of a lifetime.
Right, and the other one will go on financial television and swear it's this massive catastrophic bubble just waiting to burst.
Yeah, so wild.
It's basically the ultimate financial Rorschach test.
Yeah.
People see exactly what their underlying assumptions tell them to see. But that subjectivity is actually what makes the market function.
How do you mean?
Well, think about it. If everyone agreed on the exact value of a company on any given Tuesday, there would be no trading. I mean, there would be no market at all.
Right, that makes sense. But for someone listening to this, someone who's just trying to manage their own portfolio or understand how Wall Street actually works, that subjectivity is kind of terrifying.
Oh, absolutely.
Because we're constantly faced with this massive, almost philosophical question, like, is the stock market just a giant global casino?
Well,
Are prices just moving based on the latest rumor or algorithmic trading or, I don't know, a CEO's late-night social media posts?
or is there something real underneath all of that?
Exactly. Is there a mathematical gravitational pull holding it all together?
There is gravity. I mean, it might take years to assert itself, and the market can remain wildly detached from it in the short term, but that gravitational pull absolutely exists.
Okay, that's reassuring.
Yeah, the challenge isn't really whether intrinsic value is real. The challenge is having the right tools to calculate what that value actually is.
And that gravity is exactly what we are hunting for today. Welcome to the deep dive, everyone. Today, we are opening up the exact mathematical toolkits that institutional investors use to decide who is right in that whole bargain versus bubble debate.
It's a great topic.
We are going to completely deconstruct the mechanics of equity valuation. Specifically, we're looking at the architecture of discounted dividend valuation from R20.
Right.
And the mission today is to arm you, the listener, with the ability to look at a stock price and see the underlying machinery, to understand exactly how an analyst calculates if an asset is overvalued, undervalued, or, priced perfectly.
And while we are going to get into some highly sophisticated models today,
Oh, yeah, we definitely are.
like multi-stage growth algorithms, implied market rates, terminal valuations, all that stuff.
Yeah.
But every single piece of this architecture rests on one single incredibly powerful premise.
What's that?
It's the absolute bedrock of finance. Any investment in the world is ultimately only worth the present value of the actual cash it will put back into your pocket.
Wow. Okay.
Yeah, if it doesn't eventually generate cash for you, it is just speculation.
Okay, let's unpack this. Because before we can start valuing a company using heavy math, we have to make a very basic, fundamental decision about what we are actually measuring.
Right.
We know cash is the ultimate arbiter of value, like you just said. But when you look closely at corporate finance, a crucial dilemma comes up, which is which cash?
Exactly. Which cash are we talking about?
Because when analysts build these valuation models, the sources highlight that they generally have to choose between three main definitions of future cash flows. So they're looking at dividends, free cash flow, or residual income.
And, choosing the right cash flow isn't just a matter of an analyst's personal preference. It completely dictates the mathematical reality of your valuation.
Really, it's that rigid.
Oh, yeah. The choice is entirely dependent on the specific structural characteristics of the company you're analyzing, and crucially, your specific position in the capital structure as an investor.
So who you are matters just as much as what the company is doing.
Exactly. If you pick the wrong cash flow for your specific situation, your entire valuation is functionally worthless. I mean, no matter how perfect your math is.
Okay, let's start with the most traditional metric then, dividends. In a classic dividend discount model, or DDM, the cash flow is defined simply and strictly as the actual cash dividends the company distributes to its shareholders.
Right.
This feels like the theoretical gold standard, right? Like, you buy a piece of a business, and the business periodically hands you a check representing your share of the profits.
It really is the purest representation of cash returned to the owner. The theoretical justification is ironclad.
Yeah.
Your investment today is worth the present value of all those expected future dividend checks.
But what if I don't want to hold the stock forever? I mean, a common counter-argument people make is, well, what if I plan to sell it in 5 years?
It actually doesn't matter.
It does.
No, because the person you sell it to in 5 years, well, they are buying it based on their expectation of the dividends from year 6 onward. So even that terminal sale price is theoretically just a proxy for all future dividends.
Oh, wow. I never thought about it like that. The chain just keeps going.
Exactly. It's dividends all the way down.
But we can't just apply a dividend model to everything, right? The financial architecture is very strict about this. The reading says you only use dividends to value a company when they have a concrete, established history of actually paying them.
Right, you can't just guess.
Yeah, and you use it when their dividend policy is clearly tied to their underlying profitability. So, meaning they aren't just borrowing money to pay a dividend to, keep up appearances.
Which happens more than you'd think, sadly.
Right. And this is the most critical piece. You use dividends when you are evaluating the company from the perspective of a minority shareholder.
That perspective is everything. Because a minority shareholder is anyone who does not have a controlling stake in the company.
Which is basically all of us listening, right?
Pretty much. I mean, if you own 100 shares or even 100,000 shares of a massive public corporation, you cannot just walk into the boardroom, slam your hand on the table, and demand they distribute their cash reserves.
Right. Security would throw you out.
Exactly. You are entirely at the mercy of the board of directors. They decide when, how, and if you get paid.
So if a company is sitting on a mountain of cash, but the board refuses to pay a dividend, valuing your tiny slice of the company based on that mountain of cash is kind of a delusion because you can't touch it.
Precisely. You must value the asset based on the cash you have a legal and practical mechanism to actually receive.
This brings to mind an analogy. Let's say we are trying to value an apple orchard. Using the dividend model is like saying the orchard is only worth the specific apples the farmer actually puts in a basket and physically hands to you at the end of the harvest season.
I like that. That works perfectly for a minority investor. Because, you don't own the trees. You just own the right to the basket they promised to give you.
Now, let's contrast that with the second type of cash flow analysts use, which is free cash flow, or FCF. This is defined as the total cash left over after the company has paid all its operating expenses and made all the necessary capital investments to keep the business running and growing.
Right, the maintenance stuff.
Yeah. So in our orchard analogy, free cash flow is the total yield of the entire farm. It's every single apple produced, minus the few they need to hold back to plant seeds for next year.
It's the total surplus.
Exactly, regardless of whether they put it in a basket for you or just lock it in a barn.
And this is exactly where that shift in investor perspective happens. Valuing a company based on free cash flow is really only appropriate when you are looking at the business from the perspective of a controlling shareholder.
Like an activist investor.
Right, or a private equity firm, or a corporate raider. Because if you buy a controlling stake, you own the farm. You can fire the farmer, you can liquidate the barn, you can dictate the dividend policy and distribute every single surplus apple to yourself immediately.
That distinction changes everything. Because if I use a free cash flow model to value my small retail position in a tech giant, I'm basically acting like I have control when I absolutely don't.
You're hallucinating control.
Yeah. I might calculate that the company is wildly undervalued because they generate billions in free cash flow. But if management decides to take those billions and waste them on a terrible acquisition,
It happens.
or they burn it on vanity projects instead of returning it to shareholders,
Right.
well, that theoretical value I calculated means absolutely nothing to my portfolio.
You've just described the classic agency problem in corporate finance. Management's interests do not always align with minority shareholders' interests.
Right.
And this is exactly why using free cash flow for a minority valuation can be disastrously misleading. Now, there is a caveat. Analysts will sometimes use free cash flow models for minority positions if the company pays absolutely zero dividends, but only if they believe the company will eventually be acquired or forced to distribute that cash by market pressure.
But that requires assuming the market will eventually recognize the value of that locked-up cash, which seems like a huge assumption.
Oh, it's a massive assumption.
And then we have the third metric, which feels a bit more abstract, residual income.
Residual income is fascinating because it steps slightly away from raw cash and leans heavily into accounting realities. It's generally deployed in very specific, honestly frustrating scenarios.
Like what?
Well, Imagine a company that pays no dividends, and their free cash flow is currently negative. And let's say it's projected to be negative for the next 5 years.
Yikes. If they pay no dividends and have negative cash flow, a strict cash model would say the company is effectively worthless. Like, it's just a money pit.
Exactly. But what if that company has negative free cash flow because they are aggressively reinvesting every single dollar they make, plus borrowed capital, into building a revolutionary new logistical network?
Oh, okay.
Think of Amazon in the late 1990s and early 2000s.
Hmm?
Negative cash flow, no dividends, but they were building an empire. They clearly had massive intrinsic value.
So how does residual income capture that value when the strict cash models just completely fail?
Residual income looks at the company's book value, so its accounting net worth, and then calculates the earnings the company generates above and beyond the required rate of return on that equity.
Okay, so it's measuring economic profit, not just cash in the bank.
Right. It essentially asks, is management taking the capital we gave them and generating a return higher than our opportunity cost? But to use it, you need incredibly transparent financial reporting.
Because it relies on the accounting numbers.
Exactly. Because it relies on accounting numbers like book value and return on equity, it is highly susceptible to accounting manipulation. The earnings quality must be pristine to use residual income.
So for you listening right out of the gate, this should completely reframe how you look at your own investments. When you're evaluating those massive high-growth tech stocks in your portfolio, the ones that have never paid a dime in dividends, are you accidentally valuing them in your head based on cash distributions that simply do not exist?
It's a trap a lot of people fall into.
Right. Or are you looking at their massive free cash flow numbers on a financial website, completely forgetting that as a retail minority shareholder, you have zero leverage to force them to use that cash for your benefit? It fundamentally changes the lens through which we view a stock's worth.
It's a vital realization, but it naturally leads to the next logistical hurdle, right?
Okay.
Once we've established our perspective, let's say we are a minority shareholder and we are appropriately focusing on dividends. So the apple's actually handed to us. How do we mathematically translate those future apples into a concrete dollar value today?
This is where we cross the bridge from economic philosophy into the actual time traveler's math. We are going to build out the dividend discount model, and we have to start with the atomic unit of this entire framework, the one-period DDM.
The foundational building block. If you understand this, you really understand the entire architecture of valuation.
Let's lay out the mechanics. The model states that the fundamental value today, which analysts denote as V0, is equal to the expected dividend you will receive at the end of year one, plus the expected price you can sell the stock for at the end of year one.
Right.
You take that total sum of cash, and you divide it by 1 plus your required rate of return.
Let's pull the camera back and look at what that equation is actually doing conceptually.
Okay.
So the numerator, the top half, is simply a bucket containing every single dollar you expect to physically hold in your hand exactly 1 year from now. So the dividend check and the cash from the sale.
Right.
But the core principle of finance is the time value of money. A dollar in your hand exactly 1 year from today is inherently worth less than a dollar in your pocket right now.
Because of inflation, right,
Yeah.
and because of opportunity cost. If I had the dollar today, I could just invest it in something else.
Exactly.
Oh.
So we have to penalize that future cash to find its equivalent value today. And that is what the denominator does.
Go.
Dividing by 1 plus your required return is the mathematical mechanism that discounts that future cash backward through time. Your required return is your hurdle rate. It's the percentage you demand for taking on the specific risk of this stock instead of just buying a risk-free government bond.
Okay, let's ground this with a concrete scenario so it's not just floating in the air. Imagine we are looking at a hypothetical European electronics retailer. Let's call them BuyBest.
Okay, buy best.
So as an analyst, you look at your terminal and you see BuyBest shares are currently trading in the open market for 26 euros. That's the price on the screen right now.
Right.
Now, you do your deep fundamental research. You look at their historical payouts, their earnings guidance, and you confidently expect they will pay a dividend of 1.25 euros exactly 1 year from today.
Okay, 1.25.
Furthermore, based on your industry analysis, you project that the stock market will price the stock at 28 euros 1 year from today. And finally, you assess the volatility and risk of the retail electronics sector, and you decide you require an 8% return to justify putting your capital in harm's way.
All right, so we have all the inputs. Now we just run the machinery. The expected dividend is 1.25. The expected sale price is 28. You add them together. 1 year from today, we expect to have 29.25 euros in our bucket.
But we have to bring that 29.25 euros back to the present day. We have to penalize it by our 8% required return. So we take the 29.25 and we divide it by 1.08.
And when you run that division, the result is 27.08 euros. That is the fundamental intrinsic value, the V0, according to your one-period model.
Okay, so here's the moment of truth for the analyst. The model says the fundamental value is 27.08 euros, but the market price, like what you can actually log into your brokerage account and buy the stock for right this second, is 26.00 euros.
Because your calculated fundamental value of 27.08 is higher than the current market price of 26.00, the mathematical conclusion is that the stock is undervalued. It is trading at a discount to its intrinsic worth.
So the model is effectively flashing a green buy signal.
Mathematically, yes.
But I have to throw some cold water on this. The math says it's undervalued. It looks like free money. Does this mean a listener should take out a second mortgage, drain their savings, and buy every share of Buy Best they can get their hands on?
That would be financial suicide.
Right.
And this highlights the greatest danger in financial modeling: confusing mathematical precision with economic certainty.
Oh, that's a great way to put it.
The output of 27.08 euros is entirely unconditionally dependent on the accuracy of your inputs. The math is flawless, but your assumptions might be garbage.
Right. Like, can I perfectly guarantee that the board of directors will authorize exactly a 1.25 euro dividend? Maybe they decide to cut it to 50 cents to fund a store remodel.
Exactly. And far more dangerously, can you perfectly predict the psychology of the entire global stock market 1 year from now?
Definitely not.
You assume they will price the stock at 28 euros.
Yeah.
What if there is a macroeconomic recession? What if interest rates spike? The market might panic and re-rate the stock down to 18 euros, regardless of how well the underlying business is actually performing.
And if that terminal price drops, your entire valuation collapses.
Completely. The model tells you what the value is, only if your view of the future is flawlessly accurate.
And the margin for error gets exponentially worse when we try to scale this up, right? Because analysts rarely hold a stock for just 1 year. So they move from the one-period model to a multi-period model.
Right, the natural next step.
The conceptual logic is identical. You just string the formula out. You forecast the dividend for year 1 and discount it back 1 year. You forecast the dividend for year 2 and discount it back 2 years using a squared denominator. Year 3 discounted back 3 years, and so on. And eventually, at the end of your holding period, you forecast a final sale price and discount that back too.
The arithmetic is just repetitive division. I mean, a middle schooler can do the math, but the practical application of forecasting those inputs is an absolute nightmare.
It's absurd. Predicting the market price of a volatile retail stock 1 year from now is incredibly difficult. Forecasting the price of that stock in year 5 or year 10, it's practically indistinguishable from astrology.
It really is.
And theoretically, if you are valuing a company as an ongoing, perpetual concern, you shouldn't be relying on a terminal sale price at all. You should theoretically forecast every single dividend payment out to infinity and discount them all back.
Which is cognitively and mathematically impossible. You cannot build an Excel spreadsheet with infinite rows.
Right.
But you also can't just stop valuing the company at year 10, because the company will presumably continue to exist and generate cash in year 11, 12, and beyond. There has to be a mechanism to capture the value of forever without doing year-by-year math until the end of time.
And there is. This brings us to what is undeniably the most famous, elegant shortcut in all of modern financial theory. We are talking about the Gordon growth model, which is often referred to as the constant growth model.
The Gordon growth model is brilliant because it solves the infinity problem with a single, incredibly aggressive, simplifying assumption. It assumes that a company's dividends will increase at a specific, constant rate indefinitely, forever.
And because you make that one assumption of constant perpetual growth, the terrifying, infinitely long, multi-period formula mathematically collapses down into something so beautifully condensed you can literally write it on a Post-it note.
It's amazing.
The formula is simply V0 equals D1 divided by the quantity R minus G.
Let's translate those letters into concepts just to make sure the mechanics are crystal clear for everyone listening.
Please do.
So the fundamental value of the stock today is equal to the expected dividend next year, divided by the difference between your required rate of return and the company's constant growth rate. Value equals next year's cash, divided by your return minus their growth. It is breathtakingly simple.
But the models are very careful to outline the structural load-bearing walls required for this magic trick to stay standing right. First, the growth rate must actually be constant. Second, the dividend policy must be strictly tethered to earnings. But the third assumption is the one that really reveals the economic reality beneath the math. The required rate of return, the R, absolutely must be mathematically greater than the long-term growth rate. The GR must be greater than G.
This is where the pure math and the economic reality perfectly align. Think about the denominator of the equation, R minus G. What happens mechanically if you assume a company's growth rate is higher than your required return? Let's say you require an 8% return, but you're valuing a company you think will grow its dividend at 10% a year forever.
Well, 8% minus 10% is negative 2%, so you end up dividing next year's dividend by a negative number. The formula literally spits out a negative stock price.
Which is economic nonsense. A cash-generating asset cannot have a negative fundamental value. The math breaks. But why does the math break?
Because it's impossible.
It breaks because the assumption itself is a violation of the laws of economic physics. If we assume a single company can grow at 10% a year, forever, into perpetuity, and the overall global economy historically grows at, say, 3 or 4% a year,
Yeah.
what is the inevitable outcome?
Oh, compounding interest takes over. Eventually, that single company outgrows its industry, then it outgrows its country, and eventually that single corporation becomes mathematically larger than the entire global economy. It swallows the earth.
Precisely. It's the Pac-Man theory of economics. No single entity can grow faster than the macro environment forever. So the long-term growth rate you plug into the Gordon growth model, the G, must be a mature, sustainable, realistic number.
Right.
It will almost always be capped around the nominal GDP growth rate of the broader economy. And because equity investors always demand a premium for taking on risk, meaning R will usually be 7, 8, 9% or higher, R will naturally always be greater than a realistic macroeconomic G.
Now, speaking of that growth rate, there is a fascinating quirk in the architecture here, a special case scenario. What happens if a company reaches total maturity? Like they have absolutely no new factories to build, no new markets to conquer. They just hit a plateau and decide they're going to take 100% of their net income and hand it straight to the shareholders as a dividend. They retain zero cash for reinvestment.
Well, if they reinvest absolutely nothing in the business, their organic growth rate, G, drops to exactly 0.
Right. And if G is 0, look at what happens to the Gordon growth equation. V0 equals D1 divided by R minus 0. The growth variable entirely vanishes. The formula collapses even further. It just becomes the dividend divided by the required return, D over R.
Which is deeply elegant because this is the exact identical mathematical approach used to determine the value of fixed-rate perpetual preferred stock.
Oh, really?
Yes. Preferred stock is a unique asset class that pays a fixed, unchanging dividend forever. It never grows. It just pays out. So its value is purely the payout divided by your opportunity cost, D over R. The valuation of preferred stock is simply the Gordon growth model stripped down to its absolute bare chassis.
Okay, so we have this powerful, remarkably simple tool. But the institutional analysts don't just blindly apply it to everything. It's vital to know when to use the hammer and when to, leave it in the toolbox.
The Gordon growth model is highly specialized. It is perfect for valuing broad, diversified market indices, like the S&P 500 as a whole.
Why the S&P 500?
Because a massive index of 500 companies perfectly represents a mature, highly stable macroeconomic growth rate. It is also highly applicable to valuing individual, hyperstable, mature dividend-paying firms. Think of a massive public utility company that has a legal monopoly on power distribution in a state.
Or a legacy consumer packaged goods company that has been selling the exact same brand of toothpaste and raising its dividend by 2% a year for half a century.
Exactly. Those are perfect candidates.
But the limitation is pretty obvious. If you try to apply the constant growth model to a newly public AI tech startup, a company that pays absolutely zero dividends, is burning through cash, but is growing its top-line revenue at 50% a year.
The model is worse than useless. It's actively deceptive. You cannot plug a 50% growth rate into the Gordon growth model because 50% is higher than your required return. The denominator goes negative and the math explodes. The GGM demands maturity and stability. It cannot process disruption.
Right, up to this point, we've been using these models in one specific direction. We gather our assumptions, we estimate the dividend, we estimate the required return, we estimate the growth. We plug them into the machine, and the machine spits out a theoretical price. But what if we put the machine in reverse?
This is where financial analysis elevates from simple arithmetic textbook exercises into genuine market intelligence and behavioral psychology.
Because realistically, we don't always need to calculate the price of a stock. We can pull out our phones and see the exact price the market is willing to pay right this second. What the institutional frameworks teach us is how to use the Gordon growth model backward to essentially read the market's mind.
Through basic algebra, we can rearrange the GGM equation. Instead of solving for price, we plug the current market price in and we solve for the variables the market is implicitly assuming.
Okay, so we're solving for the unknown expectations.
Exactly. We can solve for the market's implied required rate of return, R, or the market's implied growth rate, G. To solve for R, the math tells us that the required return equals the dividend yield, which is next year's expected dividend divided by today's current stock price, plus the growth rate.
So R equals the dividend yield plus G.
Correct. And to solve for G, the implied growth rate you just shuffled again. The implied growth rate equals the required return minus the dividend yield.
Okay, so translating the formula is fine, but why is this such a superpower for an active investor or an analyst?
Think about the practical application. Suppose you are a dedicated equity analyst covering the telecommunications sector. You have spent months doing grueling, deep, fundamental research on a massive telecom company. You've audited their 5G infrastructure rollout, you've modeled their subscriber churn rate, you've analyzed their debt covenants.
You know this company inside and out.
You do. And based on all that rigorous empirical work, you conclude that this company is highly mature and can sustain a maximum absolute ceiling long-term growth rate of 3%.
Okay, so 3% is my fundamentally researched, heavily vetted G.
Now, you look at the stock's current trading price, you take that market price, the expected dividend, and a standard sector required return, and you plug them into the reverse Gordon growth formula to solve for the implied G.
Okay.
The formula reveals that in order for the stock to be trading at its current high price, the collective market must be implicitly assuming a constant growth rate of 6%.
Oh, wow. So the collective wisdom of the crowd, the market, is pricing the stock as if the company will seamlessly grow at 6% forever. But my deep, specialized research proves they can't possibly hit more than 3%.
Exactly. You immediately know mathematically that the stock is drastically overvalued.
Yeah.
You aren't just sitting back and saying the chart looks toppy or it feels expensive compared to its peers.
Right, it's not a vibe check.
No, you are taking your rigorous fundamental research and weaponizing it against the exact mathematical assumptions embedded in the market's price. You have reverse engineered the crowd's psychology, found their expectations to be physically impossible based on your research, and identified a massive opportunity to short the stock or just avoid a bad investment.
That is incredible. You're basically using algebra to interrogate the market's psychological state. But I want to pivot slightly, because if growth is so crucially important to these valuations, if growth is what drives the premium, why do some companies deliberately choose to pay zero dividends?
That's a great question.
Because they retain every single penny of their earnings, they never distribute cash to the minority shareholders, and yet the market assigns them massive, soaring stock prices. This feels like it contradicts everything we've established about cash being king.
It's not a contradiction, though. It's an evolution of the capital allocation concept. And it brings us to what is arguably the most vital, nuanced concept in equity valuation: the present value of growth opportunities, or PVGO.
Let's dissect PVGO.
Yeah.
The underlying principle here states that a firm that possesses unique opportunities to earn returns that are higher than their required rate of return absolutely should retain its earnings and aggressively invest in those growth opportunities, rather than paying out dividends.
Yeah, it all comes down to wealth creation versus wealth distribution. If you are an investor and you demand an 8% return on your capital, what do you actually want management to do?
I want them to make me money.
Right. But if the company can take their profits, invest them internally into a new artificial intelligence division, or build a highly efficient new manufacturing plant and generate a 15% return on that invested capital, you want them to keep the cash.
Because they're beating my hurdle rate.
Exactly. They are compounding your wealth internally at 15%. If they paid that cash out to you as a dividend, you would have to go pay taxes on it and then try to find somewhere else to invest it at 8%. They are literally better at compounding capital than you are.
Okay, that makes perfect sense. So how does that internal compounding actually affect the valuation formula we use? Because the basic DDM only looks at dividends. To capture this, analysts use an expanded equation. They state that the fundamental value of a stock is equal to its earnings divided by the required return, the R plus the PVGO.
Let's break that equation in half to see how it works. The first part, earnings divided by R, is what analysts call the no-growth value, or the assets in place value.
Assets in place. Okay.
It represents what the company would be worth if it fired all its research and development staff, canceled all expansion plans, and just operated its current business as a cash cow, distributing 100% of its earnings as dividends forever, without ever growing again. It is the absolute baseline floor value of the enterprise.
And the second part of the equation, the PVGO, is the massive premium slapped on top of that floor. It is the present value of all those future, highly profitable investments the market expects the company to make. So the stock price is simply the value of the dead, no-growth firm, plus, the present value of its future growth opportunities.
And this framework is intimately tied to how analysts deconstruct price-to-earnings ratios, or PE ratios. A PE ratio isn't just an arbitrary multiple, it is a direct reflection of PVGO.
Wait, read now.
Yes. The mathematical models actually derive formulas for both the justified leading PE and the justified trailing PE directly from the Gordon growth model architecture.
Let's translate those PE mechanics conceptually, because reading the raw algebra on audio is always tough. A justified leading PE looks forward. It's the price today divided by the earnings you expect next year. And fundamentally, that multiple is driven by how much money the company retains to grow versus how much they pay out, adjusted for the risk and growth rate.
Exactly. And a justified trailing PE looks backward at the earnings over the past 12 months. It essentially takes that same retention dynamic, but factors in that the earnings have already grown over the past year. But the core mechanism is the same. The multiple expands when the company retains capital and deploys it at a rate higher than the opportunity cost.
Let's ground this with a brilliant example from how analysts actually break this down. Let's say you are looking at a mature industrial company, and it currently trades at a PE ratio of 12.
Okay, PE of 12.
A financial analyst runs the PVGO equation and calculates that exactly 2 points of that PE of 12 are derived entirely from the present value of growth opportunities.
That is a profound, illuminating insight right there. If 2 points out of a multiple of 12 are from PVGO, that means 2 divided by 12, or roughly 16.7% of the firm's total market value, is completely attributable to growth opportunities.
Think about what that actually means. It means 16.7% of the stock price you are paying today has absolutely nothing to do with the factories they operate right now or the products they are selling today. 16.7% of the price is purely based on the market's collective faith that management will find profitable things to do with the money in the future.
It perfectly quantifies the market's optimism.
This reminds me of buying a professional sports franchise.
Oh, I like this. How so?
Well, if you buy a legacy, struggling team in a small market, you might just be paying for the value of the current ticket sales, the hot dog revenue, and the existing local TV contracts. You are buying the baseline, no growth value.
Right, the assets in place.
But if you buy a team that just drafted a generational superstar and they have approved architectural plans to build a massive state-of-the-art stadium and entertainment complex downtown,
Wow.
well, you aren't just paying for today's hot dog sales.
Not at all.
You are paying a massive astronomical premium, a huge PVGO, for the expectation that they will win multiple championships, sell out luxury suites in the new stadium, and secure unprecedented global broadcasting deals 5 years from now.
That analogy works perfectly for the upside. But we have to examine the downside risk. What happens if that generational superstar tears their Achilles tendon in training camp?
Oh, brutal.
Or what happens if the city council revokes the zoning permits for the new stadium?
Then the expected growth just vanishes. The PVGO completely evaporates and the value of the franchise plummets violently back to the baseline, no growth value of a mediocre team.
Which is exactly why understanding PVGO is perhaps the most crucial risk management tool for an equity investor. When you buy a stock heavily weighted by PVGO, you are buying a fragile expectation of the future, not a concrete reality of the present.
So, to you listening, pull up your brokerage account and look at the technology stocks in your portfolio right now. The AI companies, the cloud computing firms with PE ratios of 50, 60, or 100.
It's staggering.
When you run the mental math, you realize that 70, 80, maybe 90% of their current stock price is just PVGO. Are you truly comfortable paying that massive fragile premium purely for what if? It's a sobering, deeply uncomfortable question to ask yourself when the broader market is in a state of euphoria.
It is uncomfortable, but it is necessary. And it naturally leads us to the reality that companies, much like those sports franchises, are not static entities. They evolve, they age.
Right.
The Gordon growth model demands we assume constant growth forever, but that is simply not how businesses operate in the messy real world.
Which brings us to the necessity of mapping the corporate life cycle and using multi-stage realities. Institutional models break down the life of a typical business into three distinct, highly predictable economic phases.
Let's walk through the anatomy of that life cycle. The first phase is the initial growth phase. This is the startup, the disruptor, the young tech firm. They have rapidly exploding earnings and revenue. Crucially, they pay little or absolutely no dividends because they are desperately retaining every cent of cash for heavy, aggressive reinvestment to capture market share.
They need all the fuel they can get.
Exactly. During this phase, their return on equity is massively higher than their required return. They're compounding wealth rapidly.
But no company can stay in that explosive startup phase forever. Eventually you hit a wall or you saturate the market. Then comes the transition phase.
The awkward teenage years of a corporation. Earnings and dividends are still increasing, but the rate of growth begins to decelerate.
Why does it slow down?
Because massive profitability acts as a beacon. It attracts ferocious competition. Competitors enter the market, price wars begin, and the company's excess profit margins start slowly eroding. And because they can't grow as fast, the company doesn't need to reinvest quite as aggressively, so the payout ratio, the percentage of earnings they hand out as dividends, starts to slowly tick upward.
And finally, they settle into the mature phase.
The steady, predictable adult. Earnings grow at a stable, much slower rate, often just mirroring the baseline growth of the overall macroeconomy. Their dividend payout ratios stabilize at a high level because their reinvestment needs are low. They are mostly just spending capital to maintain their existing assets, not to aggressively build new ones.
Right.
Their return on equity drops down to roughly equal the required rate of return investors demand. They become a cash cow.
So if a company is organically moving through these wildly different phases, shifting from zero dividends and massive growth to high dividends and slow growth, how on earth do we value them over a 10-year horizon? The constant Gordon growth model is entirely useless here.
It is. And this is why analysts must construct multi-stage models. Depending on where the company is in its life cycle, they might deploy a two-stage DDM, a three-stage DDM, or my personal favorite for its mathematical elegance, the H model.
Let's focus on that H model because it solves a glaring flaw in the simpler designs. Why do institutional analysts prefer the H model over a standard two-stage model?
Well, think about the rigid mechanics of a standard two-stage model. It forces you to assume that a company will have a period of high growth, say 15% a year, for exactly 5 years. And then magically, on day one of year 6, the growth rate instantly plummets to a low mature rate of 4%.
It just falls off a sheer cliff.
It does.
Which makes zero sense economically. I mean, a dominant tech company doesn't wake up on January 1st of its 6th year and suddenly transform from a hypergrowth disruptor into a slow-moving, mature utility.
Exactly. Market dynamics don't work like light switches. The H model solves this jarring, unrealistic transition. It models an initially high growth rate that linearly declines over a specific, defined transition period until it eventually settles at the stable long-term rate.
So it smooths it out.
Right. It mathematically simulates a smooth, gradual glide path. This is vastly more realistic for a company entering that transition phase, where competitive forces, patent expirations, or market saturation are slowly, steadily eroding their profit margins year by year.
Okay, I see the mathematical beauty of the smooth glide path. It looks great on a chart, but I have to push back hard here.
Go for it.
If we, as analysts, are using a three-stage model or an H model, we're guessing the length of the high growth period. We're guessing the exact duration of the transition period. We're estimating the initial growth rate, the declining rate, the final terminal rate. Aren't we just creating a massively complicated pseudoscientific machine where an analyst can just move a half dozen different dials around until the model spits out the exact valuation they want to see?
You've just identified the dark secret of complex financial modeling. That is the massive, inherent, unavoidable risk of multi-stage models. The architectural framework explicitly warns that their greatest strength, their ultimate flexibility to model complex reality, is also their greatest vulnerability.
It's garbage in, garbage out on steroids.
It is the purest manifestation of the garbage in, garbage out principle.
Because if an analyst wants to justify a buy rating to their boss, they can just extend the transition period in the H model by 2 extra years, and suddenly the calculated intrinsic value jumps by 20%.
Yes, These models enable a skilled analyst to build a highly customized, nuanced, realistic view of the future.
Mm.
But because there are so many variables, they require immense, uncompromising intellectual discipline. An analyst must be able to rationally, empirically defend every single input with market data.
Otherwise.
Otherwise, if you are just turning the dials backward to justify a predetermined stock price, you aren't doing financial analysis. You are doing creative writing with numbers. You are building a facade of rigor to hide an emotional decision.
Creative writing with numbers, I love that. And I think a lot of Wall Street research reports fall into that category.
Definitely.
And that perfectly transitions us to the final piece of the valuation architecture, because no matter how many stages you build into your model, whether it's 2 stages, 3 stages, or a beautiful, smooth H-model glide path, eventually you have to stop forecasting. You can't calculate year-by-year cash flows in an Excel spreadsheet until the sun burns out.
You have to cap the model. You must draw a definitive line in the sand where your explicit forecasting ends.
And that line is called the terminal value. In the framework of equity valuation, this is defined as the estimated value of the entire company at that specific point in the future where we stop doing the explicit year-by-year math. And it's incredibly important because often the terminal value makes up 60, 70, even 80% of the total present value you are calculating.
It is the heavy anchor of the entire model.
Mm.
And there are two primary accepted methodologies to calculate this terminal value. The first is to return to our old friend, the constant Gordon growth model.
All right, so let's walk through that. Let's say we do a highly detailed, line-by-line, year-by-year forecast of a company's dividends for exactly 5 years. To figure out what the whole company is worth at the end of year 5, we assume that from year 6 onward into infinity, the company is finally mature and will grow at a constant, stable rate forever. So we just apply the GGM formula right there at year 5.
Exactly. You calculate the present value of that year 5 GGM terminal value, and you add it to the present value of the individual dividends from years 1 through 4.
Okay, so that's method 1. What's the second way?
The second accepted method for calculating terminal value abandons the dividend math entirely and uses a market multiple approach.
How does that one work in practice?
Instead of using the constant growth formula at year 5, you forecast the company's fundamental earnings per share in that terminal year. Then you multiply those year 5 earnings by an expected mature price-to-earnings ratio.
Oh, I see.
So, if your deep dive spreadsheet projects that the company will earn $5 a share in year 5, and you assume based on historical industry data that a reasonable mature PE ratio for that specific sector is 15, your terminal value is 5 times 15, which is $75.
Yeah.
You then discount that $75 back 5 years to the present day.
Okay, so we have all these incredibly stylized, academically rigorous models. The 2-stage, the 3-stage, the H model. But I have to highlight an insight from the reading that I found slightly humorous.
What's that?
After spending an immense amount of time teaching us the profound, elegant math behind these specific structural models, the institutional reality basically admits that in the real world, modern financial analysts rarely use the strict algebraic H model. They mostly just build custom spreadsheets.
It's the truth, honestly. The stylized algebraic models are absolutely crucial for understanding the mechanics of valuation. They teach your brain how growth, time, and risk interact with each other. But in practice, reality is far too messy for an elegant equation.
Yeah, a firm's dividends rarely grow at a perfectly smooth, mathematically linear rate that fits neatly into an H-model equation.
And that's exactly where spreadsheets become invaluable. Spreadsheets allow an analyst to account for idiosyncratic, lumpy, real-world events.
Lumpy events. Give me an example.
Let's say you are valuing a major defense contractor. You have insider knowledge or public filings showing they just signed a massive non-recurring 4-year government contract. That contract will produce a huge, lumpy, abnormal cash flow surge in years 3 and 4, but will drop back to 0 in year 5 when the contract ends.
You absolutely cannot force a massive, lumpy, temporary cash surge into a smooth, growth rate algebraic formula.
You can't. It would completely distort the underlying economic reality of the business.
Right.
But in a custom spreadsheet, you can literally model out those exact specific cash flows cell by cell for years 3 and 4, and then return the model to a normal baseline forecast in year 5.
So it's about flexibility.
Exactly. Spreadsheets offer brute force computational accuracy for when you have a great deal of specific, messy, asymmetrical information. The underlying philosophy is identical. I mean, you are still projecting and discounting future cash flows back to the present, but the delivery mechanism is infinitely more flexible.
Okay, let's pull back the curtain even further. Throughout this entire exhaustive deep dive, we've been tossing around this concept of growth like it's a magic variable we just pluck from the sky. We guess 5% growth, we model an 8% decline. But where does corporate growth actually come from? A company can't just wish itself into growing 15% a year.
This brings us to the final and perhaps most diagnostic tool in the entire valuation toolkit, the engine of growth. We have to look at the concept of the sustainable growth rate, or SGR. This is where we stop looking at the exterior of the car and open up the hood to inspect the engine block.
The technical definition of SGR is the exact rate at which a company's earnings and dividends can grow indefinitely without the company needing to issue new equity, meaning selling more shares and diluting current owners, or changing its capital structure by aggressively increasing its debt-to-equity ratio.
I like to call it the organic speed limit of the enterprise.
Organic speed limit.
I like that.
If management doesn't borrow any more money from the banks, and they don't water down your ownership by printing new shares, how fast can this business grow using nothing but the fuel of its own internally generated profits?
The baseline formula for this is deceptively simple. G equals ROE multiplied by B, return on equity times the retention rate.
It is an elegant relationship. If a company generates a 10% return on the equity it holds and it decides to retain 50% of its earnings to reinvest back into the business rather than paying dividends, its sustainable growth rate is exactly 5%. Half of 10.
But the institutional analysis doesn't stop at that top level. It violently breaks ROE down into its component parts using DuPont analysis, specifically what they call the pre-AT model.
Pre-RA. Let's dissect this letter by letter, because this is the true anatomical dissection of a company's economic growth engine.
Let's do it. P stands for profit margin, net income divided by sales. This measures pure pricing power and cost control. Out of every single dollar of revenue that comes in the door, how many cents actually survive all expenses and flow to the bottom line?
Equity is the retention rate. We discussed this earlier. How much of that surviving profit does management actually keep in the vault to reinvest versus how much they pay out to you as a dividend?
A is asset turnover, sales divided by total assets. This measures operational velocity and efficiency. How effectively is the management team utilizing their physical factories, their inventory on the shelves, their intellectual property to generate top-line revenue?
And finally, T is financial leverage. Total assets divided by total equity. This measures risk. How much borrowed debt is the company using to artificially amplify their returns?
So if we string it all together, sustainable growth, G, is equal to P times R times A times T, profit margin, times retention rate, times asset turnover, times financial leverage.
Let's use a real-world conceptual comparison to show how this engine actually fires and how two entirely different companies can achieve the exact same growth rate using completely different levers. Compare a high-end luxury car manufacturer like Ferrari to a massive discount retailer like Walmart.
That's a brilliant comparison. Ferrari operates with a massive P, profit margin. They charge exorbitant prices, so they keep a huge percentage of every sale. But their A, asset turnover, is very low. It takes them months to meticulously build a single car, and they sell a very low volume. Their engine relies on high margin, low velocity.
Now look at Walmart. Walmart's P, their profit margin, is razor thin, maybe 2 or 3%. But their A, their asset turnover, is astronomical. They clear out their inventory and restock their shelves constantly. They generate massive sales volume off their asset base. Their engine relies on low-margin hypervelocity.
Exactly. Both companies might have the exact same return on equity and thus the exact same sustainable growth rate, but they arrive there through entirely different operational philosophies. The Pratt model allows you to see how they are growing.
And this is why this deeply analytical component-level breakdown matters so much to an investor. Let's say a company's CEO goes on CNBC and boasts that they are projecting a massive 15% growth rate next year. As an informed analyst, you look at their historical Pratt model, which shows their sustainable organic growth rate is only 6%. You immediately have to ask, how?
It forces you to interrogate the mechanics. If their organic speed limit is 6%, the only way they hit 15% is by violently pulling one of the 4 levers in the pre-app model. They have to magically, instantly double their profit margin, which is incredibly hard in a competitive market.
Nearly impossible.
Or they have to suddenly become vastly more efficient with their asset turnover. Also very difficult. They have stopped paying dividends entirely and retain 100% of earnings, which will infuriate their existing shareholder base and crash the stock.
Or Or they pull the easiest, most dangerous lever. They increase their leverage, the T. They go to the bond market, borrow a massive, unsustainable amount of debt, and use that borrowed money to juice their returns and artificially inflate their growth rate to hit that 15% target.
And that is exactly why the Pratt model is the ultimate lie detector in corporate finance. If you see a company in your portfolio consistently boasting double-digit top-line growth rates, but you look under the hood and see that their profit margins are stagnant, their operational efficiency is flat, and the only thing driving that explosive growth is a constantly ballooning, dangerous mountain of corporate debt.
It's a red flag.
It's more than a red flag.
Uh,
That growth is a mirage. It is a house of cards. It is literally, mathematically not sustainable.
It's an illusion of growth, funded entirely by systemic risk. And eventually, the credit cycle turns, interest rates rise, the debt comes due, and the illusion collapses. The Pratt model allows you to see past the flashy, PR-approved top-line numbers and evaluate the actual structural integrity of the business engine.
Okay, let's take a collective breath here. We have journeyed through an incredibly dense, profoundly important landscape today. We set out to find the gravitational pull of the stock market, and we've covered massive, complex ground.
We absolutely did. We started by establishing the foundational rules of engagement, defining what cash we are actually allowed to measure. We learned to differentiate between the apples in your hand, dividends for minority shareholders, and the apples on the tree, free cash flow for controlling interests.
We tackled the time traveler's math of the one-period and multi-period dividend discount models, internalizing the philosophy of opportunity cost and how to penalize future cash to find its present value.
We discovered the elegant, infinite shortcut of the Gordon growth model, exploring the economic constraints of growth. And crucially, we learned how to run that machine in reverse, interrogating the market's current price to extract the crowd's psychological expectations and spot irrational pricing.
We explored the present value of growth opportunities, quantifying exactly how much of a high-flying tech stock's price is based purely on a fragile faith in future investments versus the concrete reality of assets in place.
We navigated the messy reality of the corporate life cycle, moving from hyper-growth startups to mature cash cow utilities. We examined how multi-stage models, specifically the smooth glide path of the H model, attempt to capture that evolution while acknowledging the severe dangers of manipulating the assumptions. We saw how terminal value anchors the math, and why analysts ultimately abandon elegant algebra for the brute force reality of custom spreadsheets.
And finally, we looked under the hood with the Pratt model. We learned how to deconstruct return on equity to ensure that the growth we are paying a premium for is driven by a sustainable, organic economic engine, and not a dangerous illusion built on borrowed money.
It is a comprehensive, institutional-grade toolkit for piercing through the noise and seeing the underlying reality of the financial markets.
But as we wrap up this deep dive, I want to leave you, the listener, with one final, deeply provocative philosophical thought to mull over.
Okay, lay it on us.
All of these rigorous mathematical models we've discussed today, from the simplest one-period DDM to the most complex multi-stage spreadsheet with meticulously calculated sustainable growth rates, they all rely on one massive, underlying, entirely unspoken assumption.
Which is?
They assume that the stock market is, ultimately, a rational weighing machine. They assume that eventually, given enough time, the market price will inevitably gravitate toward the precise fundamental intrinsic value we just calculated.
That is the ultimate terrifying tension in finance, isn't it? Because we know from behavioral economics that the market is made up of humans, and humans are frequently spectacularly irrational.
Right.
What if the market isn't rational? Or as the old trading adage goes, what if the market can remain irrational much longer than you can remain solvent? If your rigorous, perfectly calculated DDM math proves unequivocally that a stock is deeply undervalued, but market psychology, algorithmic momentum, and macro trends keep that stock undervalued for 10, 15, or 20 years straight. At what point do you have to look in the mirror and admit that while your math is technically flawless, the reality of human behavior makes your math entirely irrelevant?
That is the beautiful, terrifying, unresolvable friction between the rigorous science of corporate valuation and the chaotic art of human investing.
Math gives you the intrinsic value, but human psychology sets the price.
And navigating the gap between those two numbers is where fortunes are made and lost. Thank you for joining us on this incredibly extensive deep dive into the mechanics of equity valuation. I hope you walk away from this looking at your own stock portfolio, not just as a list of blinking red and green prices on a screen, but as a collection of intricate mathematical cash flow engines just waiting to be decoded. Until next time.